If you've ever wondered whether stockholders' equity can be negative, the answer is yes. It seems odd because sometimes people see stockholders' equity as being the value of the company, but you have to remember it is the book value of the firm. It is not the market value. The stockholders' equity does not tell you what you would have to pay in order to buy the company. Okay, we think of that as the market value of the company's equity. Stockholders' equity is just telling you the value on the balance sheet. And it's, again, seems odd having a negative value of something, but think about it like this. We've got assets equal liabilities plus equity. And all this is saying is, let's say we had $100 of assets, and then we had $120 of liabilities, we'd have negative stockholders' equity of $20. Now, how does this happen? You might be wondering, how do we get in this scenario where this is negative? Because if you're thinking about the common stockholders' equity accounts that you would see, you'd see common stock, additional paid-in capital, and so forth. And you might wonder, well, common stock can't be negative. So how is it that we get into this situation where we have negative equity? And what happens, which usually the culprit is, we have a large series of losses. The company is losing a lot of money, and that leads to an account called accumulated deficit, which, if you remember, accumulated deficit is basically retained earnings when retained earnings has a debit balance. What that means is when retained earnings is negative. Remember, retained earnings is the accumulated profits of the company, all the net incomes it's ever had, minus the dividends it's distributed since the company's inception. Okay, so all the profits have been reinvested in the company. That's retained earnings. But if that's negative, think about a company that's never had any profits and they just accumulate loss after loss, or maybe they were profitable at one point and then they started accumulating a lot of losses. When retained earnings account becomes negative, then at that point we have this account called accumulated deficit. So you might have common stock be $100 and additional paid-in capital be $500, but then you have this accumulated deficit account would be, let's say, maybe it's negative $800. Okay, so in that scenario, you say, well, we have $600 of equity here, but minus the $800, we have negative $200 of stockholders' equity. So in that scenario, you say there's actually a negative book value of the firm. The market value can never go below zero, but the book value, the stockholders' equity, can. Now, what does this imply? Well, when you have negative stockholders' equity, usually the company will go bankrupt at some point very soon. It does not guarantee it. Remember, companies go bankrupt when they run out of money. If you run out of cash, you're definitely going to go bankrupt. But theoretically, if you had negative stockholders' equity, as long as the company continues to be able to borrow money, right, if they can issue debt or something, if people keep lending money to the company, it could conceivably stay in business. However, when we see this scenario with negative stockholders' equity, it means the company is losing a lot of money. This accumulated deficit account is piling up. That's why it's causing equity to be negative. The company's losing a lot of money, and so eventually people say, I'm not going to lend the company money anymore, and so forth. And also another implication, you might be wondering, well, when there is negative equity, so like in this scenario where we have negative $200 of total stockholders' equity, so by the way, which we call a total deficit. When it's so if we have negative 200 here for total stockholders' equity, we wouldn't call it stockholders' equity, we call it total deficit. So when we have a total deficit or negative stockholders' equity, the shareholders do not owe the company money. Some people might think, well, do they actually have to send a check for $200? No, the shareholders, all they can lose the value of their stock. Like their stock could become worthless, but they're not then going to owe the company money. Let me give you an example with a couple of actual firms that had negative stockholders' equity or total deficit at one point in time. So this is just an excerpt here from Sears' balance sheet as of February 3rd, 2018. And I say excerpt because I just have total assets and liabilities. I didn't break out the separate parts. I'm just to make it easy so we don't have a massive amount of information on the screen. And you'll see we've got assets, liabilities, but then instead of equity, it says deficit. And it says deficit. And then it gives a breakdown here of what is going on in the deficit. And we see that the company, we've got common stock. Now we've got treasury stock. As you remember, treasury stock is actually a contra equity account. So that also, you see it's in parentheses. That is actually reducing the equity and contributing to make it a deficit as well. However, most of the time, when you see a scenario where you have negative equity, it's not just, you don't have like some profitable company and it's like, oh, we repurchased so many of our shares that now we have negative equity. In theory, that could happen, but that's usually not the case. Here, it's just Sears at some point in the past repurchased a lot of its shares, but then they also were losing a lot of money. And these amounts are in millions. So this is actually, they have their accumulated deficit, which they call retained deficit, but it's their accumulated deficit, negative retained earnings, almost $5.9 billion. So that, in conjunction with, they have some accumulated other comprehensive losses. If you remember accumulated other comprehensive income, well, you can also have accumulated other comprehensive loss. It's just losses that bypass the income statement. So these bypass the income statement here. So you could think of this as similar to this retained deficit, right? These accumulated other comprehensive losses. These are all losses. That's what that is. That's all losses. And then here is just the company repurchased shares at some point. So that's contra equity. So you've got these three different accounts that are being subtracted. And so you see that Sears has this deficit, $3.7 billion total deficit. And so liabilities, if we subtract the deficit, we get to the total assets. So we still have assets are equal to liabilities plus equity, although in this case the equity is negative and it's called the total deficit. Okay. Now I want to give you another example with Gymboree. So this is Gymboree's balance sheet, and again it's just an excerpt. We got assets, liabilities, and then we've got the deficit portion here. So as of January 28th, 2017, we've got assets, and then again, liabilities exceeding the assets because we have a deficit. We have a total deficit. Now, these amounts are in thousands. So this is $609 million of total deficit. Now, here, Gymboree has not repurchased any shares. So you don't see treasury stock up here. So you don't see that as a negative amount. But again, we have the accumulated deficit. So again, it's that the company has accumulated a lot of losses, and then they also have this accumulated other comprehensive loss as well. But the main thing is Gymboree has been losing money. They've been losing money, and so that led to the deficit scenario.